Treasury yields are jumping as strong US factory data further dampens expectations the Fed can cut in June. That broke a surge in the gold price overnight, which had hit a new high. China's manufacturing activity is also on the rise. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, says this quarter's data is where the rubber will have to meet the road for whether central banks can cut rates this year.
If the FOMC is correct that it expects to be able to cut interest rates at a later stage this year, numbers really need to start to improve from March onwards and persistently improve throughout the second quarter.
But first, in 5 and 5 with ANZ, US Treasury yields are surging this morning as traders reduce their bets about a June rate cut from the Fed. This is after US factory activity beat all expectations by expanding in March for the first time since September 2022. Yields rose 10 to 14 basis points, which pushed up the US dollar and the Aussie and Kiwi dollars down. This change in expectations about interest rates also interrupted an earlier surge in the gold price, which has retreated from a fresh record high overnight. Meanwhile, Chinese manufacturing activity is also on the rise, expanding for the first time in 6 months, according to the official March PMI out over the weekend. It's a jumpy start to the second quarter after the first quarter ended with the Fed's preferred PCE inflation measure cooling in February. PCE inflation of 0.3% was below the 0.4% expected. ANZ senior rate strategist Jack Chambers says comments from the Fed chair Jay Powell following the PCE data indicate the Fed is looking for further signs that inflation is weakening.
He described the inflation data so far this year, including Friday's PCE data, as being largely in line with expectations. He also said that he doesn't see an elevated risk of a recession in the economy right now. Overall, the messaging was pretty similar to what we've seen before from Powell, and I think it supports our view that the Fed needs to see more deceleration in inflation before it can be confident about easing.
Number 2, those higher US Treasury yields are driving strength in the US dollar, with the Aussie and Kiwi dollars trading down 0.5% at 64.86 US cents and 59.44 US cents respectively at 4 a.m. Sydney-Melbourne time. Turning to Australia, ahead of Easter, data showed monthly retail sales rose 0.3% in February. Now that was below the 0.5% expected. ANZ senior economist Blair Chapman says while Taylor Swift concerts did lift clothing sales and department store spending, the underlying non-Swift data was weaker.
We've been expecting retail sales to be slower overall, just as the cost of living crisis is sort of biting at the moment, and we'd anticipate that to start turning later on in the year with fiscal policy and monetary policy easing.
Number 3, Australian job vacancies were down 6.1% in February from 3 months ago, according to the ABS. That was the 7th quarterly drop in a row. Blair says job vacancies are now down 23.5% from their May 2022 peak.
We are expecting as the labour market slows that job vacancies will continue to fall. The one thing we haven't seen really is the unemployment rate increasing at the same sort of magnitude you might expect when job vacancies fall, and that's because job vacancies are at a level that's so much above where they were pre-COVID, and we're sort of only just returning to pre-COVID levels where the labour market was sort of in balance.
Number 4. In New Zealand, consumer confidence took a hit in March, dropping 9 points after steady improvement in recent months. ANZ New Zealand chief economist Sharon Zollner says responses in every week of the month were down on February.
The Reserve Bank does need it to crack as well, really, given it's just such a large chunk of the economy and a large chunk of that non-tradable inflation. So the Reserve Bank will be watching that sector with particular interest, and there were perhaps a few signs of things cracking. More of their indicators fell than rose this month, and indeed they were probably a bit of an outlier in terms of the deterioration seen this month.
Number 5. It was the same for businesses. The ANZ Business Outlook showed confidence down 12 points, with weaker results following the recession headlines. On the inflation fighting front, Sharon says there are cracks emerging in New Zealand's services sectors.
The last week was particularly weak. And what happened during that week was headlines of recession. The Q4 GDP data came in at minus 0.1, which just squeaked into the definition of a recession. So there were some pretty alarming headlines out there, and that does appear to have impacted confidence.
Sharon Zollner there. Now, in today's bonus deep dive interview, ANZ Head of G3 Economics, Brian Martin, says Q2 data will be all important for whether central banks really can start cutting interest rates this year.
It's going to be a very important quarter, Q2, in confirming whether or not central bank guidance is accurate, that the central banks will be able to cut interest rates this year. We've seen a bump in US inflation data in January, and we're expecting that to be repeated in the PCE data that is published this Friday for February. But thereafter, if the FOMC is correct that it expects to be able to cut interest rates at a later stage this year, numbers really need to start to improve from March onwards and persistently improve throughout the second quarter.
And what are you seeing from Fed officials, ECB officials, about whether that rubber has met the road?
I think the ECB is increasingly confident that it has put in place adequate restriction to allow them to start cutting interest rates, probably at the June meeting. It was interesting that some of the hawks have been indicating they really want to see confirmation that wage inflation is normalising in Europe before beginning the process of cutting interest rates. The ECB chief economist did say today, though, that he is confident and feels the ECB is confident that that wage normalisation process is in place. Indeed, that's our assessment as well. But I think central bank officials really want to see the whites of the eyes of the data before cutting. And we're not going to get the negotiated wage settlement data in Europe out until late April, early May. So I think that's why they're hanging on for a June cut, although I do think the conditions for rate cuts are probably in place at the moment.
But it's not quite so certain in the United States, is that right?
That's right. There's been this rise in inflation, particularly core PCE inflation and core CPI inflation at the start of the year. The inflation in the services sector and the services sector, excluding shelter, has been really quite strong. Now, we think that is down to problems with seasonal adjustment at the start of the year that has followed the pandemic. Normally, service sector firms, indeed most firms, lay out their price increases at the start of the year. And we think it's statistically just quite difficult for them to adjust for that in the aftermath of COVID. And we fully expect that the prices will normalise. But again, the FOMC needs evidence that that is occurring. We don't think it will have adequate evidence until the July meeting to allow them to start cutting interest rates.
For those wondering about the difference between the United States and Europe and some other economies, how much of a role is fiscal policy playing?
It's played a much stronger role in the US. The government was very proactive in supporting people who are out of work, in supporting households. And I think that is because the US doesn't have the automatic stabilisers in place, i.e. when people lose their jobs, they automatically go on to social security safety nets. So the US put that in place. And one of the impacts was they had quite a thorough and quick recovery in employment, but owing to the pandemic generosity, savings were built up a lot in the US, and that has supported above trend levels of consumption activity. In addition, we've also had some very key measures like the infrastructure bill and the Inflation Reduction Act, which both contain a lot of money for spending on infrastructure, for spending on climate, for spending on electrification, digitalization, all those types of things. And that's continuing to power through the economy. We don't have that in Europe at the moment, where, in fact, if anything, we're seeing a net fiscal contraction this year. So I think the fiscal backdrop is playing a part in central bank confidence with which they can pursue rate cuts in the near term.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 2nd. Catch you tomorrow with a review of the RBA's March meeting minutes. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.